There we go. I'd like to welcome everybody to Lunch and Learn today. We have a group here from Westwood Financial, and I'll let you guys introduce yourselves, but they're going to go through a presentation. Feel free, if you have questions, you can drop them in the chat, or we can wait and do a Q&A at the end if there's time. You know, there should be time, hopefully. But feel free to drop questions in the chat as we go along. But outside of that, I will turn it over, I guess. Mark, do we start with you?
Yeah, I'll start briefly. And Chad, thank you for having us. And, we look forward to the discussion. And, by way of background, my name is Mark Brett, CEO. I've been the CEO for 4 years now. Prior to that, I was on the board and had a variety of different jobs at CBRE, a public REIT, et cetera. Which you can see on the end. Lauren Ball, who's with us, she heads up our leasing, redevelopment, legal, and marketing, and she's in Atlanta. Julian Wee is in LA, in our Los Angeles headquarters, and he heads up finance and accounting for us, as well as tax. And then Brett Johnson, who's also on, is our vice president. He is operations and investor relations on an interim basis while our new IR person comes on board in January. And I think that what we want to talk about is a couple things. One is we're going to talk briefly about Westwood so you understand our background. And then we're going to go wide. Retail is a very broad category, as you're going to see. But as you all know, there is a single tenant net lease. There are strip centers. There are community centers. There are neighborhood centers. There are power centers. There are malls. There are lifestyle centers. And all of them have different risk rewards to them, and we're going to focus to some degree on that, and then we're going to focus in a little bit on what we believe, what our investment strategy is, what our operating results have been, and some recent investment examples. So having said that, I'm going to start off with the first page here, which is about Westwood. So we've been around 53 years. We've done a lot of transactions. We have 54 professionals and 4 offices. We are not a high leverage player. We believe typically in 50% leverage. And we want to be generally in growth states, as you can see on the side there. The fifth bullet point down. All of those are growth states, with really the exception of Illinois. And so I think those are ones that are interesting to us because we look for employment growth, we look for job growth, et cetera. We want to be where people want to be, and it has proven to be absolutely correct because we've had much stronger performance, I'd say, in the growth states than we have in a state like Illinois, for example. Our focus generally is grocery anchored with a couple exceptions, but these are the top grocery relationships we have, and we have key national relationships with a lot of major retailers. We do have a board of directors, 3 independents, and then 6 total members. So moving on to the next slide. Retail sector overview. This is the broad section. So we just want to talk about the different retail property types because, as I mentioned, and I'm omitting malls, I'm omitting lifestyle centers. I'm focused in on 4 categories, really. So we have strip, neighborhood, community, and power. Well, Mark, what's the difference between all those? Those are size, number one, and then number of anchor tenants. You can see strip doesn't really have any anchor tenant. Walgreens to us is not an anchor tenant. An anchor tenant to us typically is 30,000 square feet and above, typically a grocer or could be others. Neighborhood center usually only has a grocer and serves a neighborhood. And as you can see, 2 to 4 mile sort of trade draw. And, I don't know if you're familiar with the term trade area, but for us in retail, it's very important. I think it's we look for certain demos, like in a neighborhood center, we'd look for 3 mile population of about 80,000 at a minimum and household income of about 80,000. And why do we do that? Because to us, the trade area to some degree determines your destiny of your investment. If you don't have a good trade area, it's going to be very difficult to attract the kind of tenants that you want to attract. So that's a key focus for us. So we definitely, our average actually is 100,000 and 100,000. So 100,000 pop, 100,000 income for average household income. Community centers are larger. We buy them occasionally. We are a little more cautious with them because they have more boxes. And, boxes can be great if they're dominant, is a dominant center and there's limited supply, et cetera. But often I see sometimes, sponsors putting either community or particularly power centers out there at fairly high cap rates without understanding what all the risks are. And there are much more substantial risks, particularly in the power center, which I will discuss in a minute. But the important parts are community center draws a little bit wider, is larger, and power draws from a 7 to 10 mile radius. So going to the next slide. Retail tenants are, there's a broad variety, but overwhelmingly the discount value tenants are doing extremely well. And whether you look at Costco, TJ Maxx, the dollar stores, some of the discount or, more mainstream grocers compared to some of the higher end grocers, et cetera. In this economy, this is who's doing well in our portfolio. And that's why we're 97% leased. Who isn't doing well? And we don't have many of these. We don't have any department stores. We don't have any movie theaters. We don't have any furniture stores. I don't think we have any party stores. We don't have any Barnes and Noble. So why are they underperforming? Because many times they have a flawed business model. The department stores are being undercut by the TJ Maxx or Ross, et cetera, of the world. You're familiar, I'm sure, with what's going on in the movie theaters. Bookstores, hey, you got Amazon. Furniture was doing well for a while, but in this economy, people are waiting on furniture. General merchandise could be a wide variety of things, but often it means full price. We stay away from full price generally. So anyway, the point here is your tenants determine your success to some point. To some extent, it's okay to have 1 or 2 weak tenants. But if you have many weak tenants, you got a problem. And the cap rates, in my opinion, don't matter because you're going to have major issues, particularly in the power center category. And that's not what we do. You could have exclusives by some of the tenants that restrict you from leasing. You could have co-tenancy options, which means they pay half rent if there is a co-tenancy failure, meaning a tenant that was identified moves out, et cetera. So that's a little bit it on the tenants. So moving on to our the strengths and weaknesses, opportunities and threats. Now, this particular slide is particular to what we do. And what we do is really, to some degree, strips, neighborhood, the occasional community center. And so we think the strengths, and it's not really realized, but we've had tenants stay with us for 20 or 30 years, renewing over and over again. And why do they do it? Because they make their living at this particular location or locations. And this is driving their cash flow. And so despite the rent being above market, their customers know where they are and that's where they go. If they were to move somewhere else, it takes time and they lose sales and someone else may take the space that they had, et cetera. So they tend to stay. And that means rising rents and typically low CapEx, which is a big benefit. I talked a little bit about the tenants, on the previous page, but on our centers, it's grocery and restaurants, and it's services, beauty, fitness, liquor, pet, health, et cetera, which means they're typically pretty resilient during a recession. Also means they're less susceptible to the internet, et cetera. We're finding tenant demand exceeding the supply of good locations. And we're getting, great occupancies and strong rent growth. And I think the last point, we often get tenants who like our centers, want to expand, et cetera. What are maybe I'll go with the weaknesses. So the rental increases on some of the grocers can be minimal. In some cases, they're zero could be 2 decades. So we have to factor that in when we buy a center. We want rent growth. We like the stability that the grocers give us from a credit perspective, from a draw perspective. Our typical center probably draws 800,000 to 1 million visits a year. But we like the grocers, but we have to be compensated somehow. We either are going to try and get some lease up of shop space, et cetera, or there has to be something else that works for us to buy something, a grocer without rent increase. Let's see, the rental loss, I think, from the small shops in a prolonged sort of downturn could be significant. We're going to show you the slide of what our leased occupancy was during the pandemic, et cetera, so you can see that for yourself. The opportunities. One thing that's you never really get in apartments, industrial or office is when you replace a weak tenant with a better tenant, and you do that a couple different times, you have a more vibrant center because good tenants want to be with good tenants. And as a result, the center becomes even more dominant. So that I think certainly is helpful. And we've done some renovations. Lauren led a renovation in Atlanta, and we've been able to drive rents probably 20 to 25% on average. So I think that can be a big plus. What are the threats? Typically an anchor tenant moves or goes dark. In our 53 years, we've had one grocer go dark. They're still paying rent. And we're going to replace them at the same rent, but it occasionally does happen. Now, anchor tenant on a power center, they go dark much more often. So that's concerning. But anyway, those are the strengths, weaknesses, opportunities, and threats. And I think, Junior, what's our next slide? Financial overview of Westwood. So moving on. So this is my last slide, or actually second to last slide, but the property focus, we're focused on grocery anchor, we're focused on strip, and we're focused on open air, basic community centers. Why are we focused on these? Because grocery's here to stay. The grocers have done extremely well. If you look at Kroger's latest earnings, I think their same property NOI or same store NOI was up 6%. They are doing, all the grocers have done very well, particularly since the pandemic, and more distributing from the actual, the store itself. The growth in the essential shop tenants, I think, has been substantial. I think as people, we've had, basically new shop tenants who come in who basically getting out of corporate America. They sold their Amazon stock as a literal example. And they're opening up their a concept they believe in, et cetera, and the wife is going to run it, et cetera. So we get a fair amount of that. Larger centers we like, depending, we're going to tell you about one at the end. They have more potential reward and they're also higher risk. But if you pick the winners and the losers in the right category and you know what you're doing, and I've had 30 years of sort of doing this, and I worked at as chief investment officer at a major retail REIT, and that's basically all they bought was larger centers. So I understand the category well, as does Lauren, Julian, et cetera. Philosophy, we got to know our tenants, we got to know the competitive set, you got to know your trade areas. We talked about the employment, and we think market rents are a far bigger factor in returns than initial cap rate. Initial cap rate is interesting, we pay attention to it, and we definitely pay attention to equity yields, but we're interested as much in total return as we are just initial cap rate. And some people don't realize this, but we use data from mobile phones. Every one of your mobile phones, its data is being sold to a provider, and it can provide basically insights, not to you personally, it's made anonymous, but to how that center does, who does well at the center, who doesn't, how do they stack up against their competition. So we're pretty analytical on what we do, which is why I think we've been successful. So I am going to let someone else take over. So,
sure. So speaking, thanks, Mark. So speaking to, exactly that trade area that Mark was talking about, this is where we're strategically located in all the markets, and, all the yellow stars that you see on the screen are our offices, obviously headquartered in LA, but have a heavy presence in Phoenix, Dallas, and Atlanta, the Carolinas and Florida, also with properties there. Our geographical conference concentration, those are the growth states that we believe in. Those are the states that have income growth, but population growth recently. So very, very excited to be there at this time. I'm going to go ahead and turn it over to Lauren and talk about a little bit more in depth of our tenant concentration and tenant allocation.
Sure. Thanks, Gian. As he mentioned, 85% of our portfolio is located in that Sunbelt market. 90% of our portfolio is either in the strip or neighborhood space. And so what we wanted to show you here is the top 10 tenants by our ABR, which, as you can see, 5 of those are grocery tenants, and not only grocery tenants, but the top grocers that you want to be invested with: Kroger, Albertsons, and H-E-B. On the right side of the screen here, you can see our tenant category allocation, and going back to Mark's kind of strengths, grocery being 44% of our makeup. And if you look, the food and beverage, services, and grocery, all internet resistant businesses make up 80% of our portfolio on an average base rent basis. The next slide we wanted to show, which is extremely impactful, is what we've done from pre-COVID all the way up until today. Really kind of going back to Mark's point on our neighborhood and strip shopping centers and how these tenants continue to stay with us year after year. This shows from pre-COVID, we're at 93% leased all the way to the depths of COVID. We only got down to 92% leased. But since then, we've been able to maintain such a great leasing velocity of 480 bips. On top of that, that shows that we're also retaining these tenants to bring us up to 96.8% leased today. On the bottom line, the blue line shows small shop leasing. And again, really a testament to those tenants staying long-term.
And then actually just speaking to that, to add on to what Lauren mentioned, one of the biggest measures that leasing looks at is net absorption, and that's across most industries in real estate. Really, it's all the new leasing that one does. So far this year, in 3 quarters, Lauren and her team were able to achieve over 100,000 square feet of positive net absorption, meaning we are leasing up 100,000 square feet of all new leasing that has not been done before in prior years or quarters. With that said, speaking of the pandemic, when the pandemic first hit, we were very concerned, and we as a firm did multiple scenarios, downside scenarios from small shop rental loss, as Mark alluded to earlier, with severe and prolonged recession. No one knew what was going to happen. And even for us, we were a little surprised at the results of what had happened. I get calls from lenders all the time and banks asking our performance, and really happy to share the slide with everyone. From 2019 to 2020, same store NOI growth on a GAAP basis, the average public REIT lost about 8.5% year over year, all the way from 14, about 4% for PICO. Westwood Financial lost 1% on a GAAP basis of same store NOI. And on the right-hand side, you'll see our leasing results. We lost only 70 bips, whereas the average in blue is roughly about 300 bips of leasing loss. And you might ask why that happened. That goes back to what Mark and Lauren was saying. Our focus in those MSAs, those growth states with income and population, and additionally, more so focused on small shop, where those tenants, it's their livelihood, that they put everything they had into keeping the stores alive. So kudos to the leasing team, but also to every one of our tenants that really got through the pandemic along with us to achieve these results.
And Julian, I would add, we generally gave no abated rent. We gave rent deferrals. Occasionally we gave abated rent, but almost always was deferrals.
Yeah, great point. We actually gave very, very little rent abatement. I think it was probably a handful of maybe 2 or 3. Deferred rent, about 2.8% of our total rent was deferred, and everybody paid back. Our rent deferral collections was about 94 to 95% throughout the pandemic. It ramped up to 98% in 2021.
So, and putting that in perspective, if you have a particular shop, store, et cetera, we're in the middle of a pandemic, and we have debt service to pay, we have expenses to pay, et cetera. So we want to be sympathetic, but I think the point that I'm driving home is these tenants, this is their livelihood, and when you have good locations, they stay, because it's hard to find good locations. So 2 examples. This is something that we actually closed with Crowd Street, actually, which I'm sure you're all familiar with, in late September. We had bought it earlier in the year with a vacancy. Lauren, because she's Lauren, was able to get the vacancy where there's a vacancy where you see Pop Shelf. So when we bought it, it was 74% leased. This was a value add center. And then within 4 months, she basically had a deal with Pop Shelf to take that vacant space. And we also had another space in the corner that she was able to get a much higher salon concept in there. And then we had a decision to make. Do we want to keep it and sell it in a couple of years, or do we want to introduce CrowdStreet? We decided to introduce CrowdStreet because it was one at our cost, by the way. We decided to go with CrowdStreet because, we're very well capitalized. We're talking about, we have one fund, we have equity about 750 million, debt of about 650 million, et cetera, and we're one large fund. But we also see opportunities, and some of our investors are getting older, so we were looking to replenish our investor base a little bit after a long time of not needing to do that. That's one of the reasons we're on this call. But we put it on CrowdStreet, and we were able to raise $7 million, which was significantly above their expectation. It's a double. And this is the IRR we're projecting: 16.8, 15 net to the investor, 8.3 average cash on cash, 1.5 multiple, 3-year hold. So Pop Shelf, Lauren, opened when?
They opened 11/15.
11/15. And Lauren, who owns Pop Shelf and what's the concept?
Sure. So Pop Shelf is a Dollar General concept. They came up with this concept to attract more of a female, middle to upper middle class shopper. You walk in the store, it's extremely inviting, very well merchandised. It has a good mix of kind of the home goods type feel, in addition to kind of has a little like toy section, as well as some pet products and some kind of everyday grocery needs.
Yep. And we've been able to do some renewals and leasing, and it's gone very well so far. So next slide. This is a community center. So we do buy community centers. They have to be a dominant center, which this one is. There were a couple of attractions here. One, it is in the Denver to Boulder corridor, in Colorado. And there's a tremendous amount of growth here, both employment, population, et cetera. And this center sort of dominates that particular corridor. So probably a 7-mile draw, I would say, on this one. It has TJ Maxx. It has Home Goods. We should have Home Goods. We should have Home Goods on there as well. But there's a TJ Maxx Home Goods concept. For those who are not familiar with it, I'm sure your wives may be familiar with it. But TJ Home Goods is a investment grade category killer. They do extremely well. Michael's Crafts, I'm sure you're all familiar with. PetSmart does well. Skechers as well, Dollar Tree, et cetera. And I mentioned earlier the mobile phone data. We were able to run mobile phone data where we didn't have tenant sales because we use it as a measure of success. And all of these, with the exception of Old Navy, which we have a plan for and factor that in the underwriting, screened extremely well in terms of their productivity, the number of visitors to the center, et cetera. And importantly, we were able to buy it at a relatively high cap rate because honestly, if there's a grocer in this, it would have been a significantly lower cap rate, but we were able to buy this at a 7.4 cap rate with some lease up available and assume debt in place of 3.8%. And I would say that is a common what we're looking for today. Just to digress for 1 minute, which is, the debt markets are really restricted right now. And what we don't want to do is borrow short-term and buy a long-term asset. So what we're doing now is that we are certainly making sure that we have the debt commitment in place for whatever the hold period is, and then making a decision to go forward on a particular center. We see a lot of people get hurt on short-term debt, where they're really having problems now. And I say that across property types, not just particular to retail, but that's not what we do. On this particular deal, the investors are getting a 10% cash return, a 14 levered IRR, 1.8 equity multiple, everything is 5 years. So I think that's the last slide, Julian, if I'm not mistaken. Oh, the appendix. So briefly, and then we're going to take questions on the appendix. This is a little bit on the board that we have, people's sort of experience. If you go to the next one, a little bit on the team that you're seeing here as well. If you go to the next one, Brett's there. And so Brett, I left you at the tail end. I don't know if there's anything I've missed that you would like to add, but since you're on the call and, you are heading up IR at the moment. Anything you want to add?
Well, all I would say is that, Westwood, prides itself on its relationships with its investors. A lot of these relationships have grown and nurtured over the years, a 50-year relationship. And they've continued to do extremely well as the portfolio has grown, as our company has grown. And we're happy to be in a position where we look at these. We have almost over 450 high net worth individuals in our fund who we have really long-term and trusted relationships with. I think that's really key. This is a relationship that has to be proven time and time again, and Westwood's been up to the challenge.
That's well said. And Julian, if you could just throw the deck back on for 1 minute on the front page. I just want to show the contact information.
Give me a sec. Let me do that.
So you can see on the right-hand side there, anyone who would like this deck, if you'd like it, please email myself or Brett. Our contact information is there. Our headquarters address is there. We're happy to send you the deck, etc. So that's really all I had. So you can drop that so we can see the investor group, etc.
Oh, that's
So we're
great.
happy to answer any questions that Chad, you or anyone else has.
Yeah, no, appreciate it. Great stuff. Thank you for sharing and everything. Let me lob it out to the group first and see if anybody has any questions, anything that you want to ask of the team. One thing I'll throw out at you is a softball for you. We have a mixed bag of accredited and non-accredited in our group, and our non-accrediteds are always looking for other opportunities. Do you guys get into 506B kind of scenarios, or are you strictly 506C?
We're typically C and accredited. At some point we may think about B, but right now we're C.
Gotcha. So we're always looking to tag on some extras for those that are in our community that don't have that accreditation status just yet. So I always like to ask that question. So, okay, I'll give you a little more hardball one then. So the economy is what it is these days. Speak to us about why we should feel like going into retail. It's a good time to do that. Coming out of the pandemic and all the upset that retail seemed to have with it, which you showed stats you guys stayed well maintained, it looks like. But going into kind of potential recession, everything else, speak to, where you guys see that affecting your world, your industry, and why we should or shouldn't invest with you guys as well.
Yeah, I think, so Chad, when you look at what's, a recession next year, let's say it's, I don't know if you have a view. I personally think there is going to be a recession. Do I think it's going to be severe? I think it depends on what interest rates are. I would say a couple of things. One is if our tenants made it through a pandemic, once in 100-year pandemic, and we had the operating stats that are shown, we got paid all that deferred rent, I think that's a sign of a very strong indicator of resilience, and the fact that these tenants are good tenants and generally are going to work very hard to stay in their space, and I think they're going to do extremely well. And the other point I'd say to you, Chad, would be remember how big a category is. I think America's over retailed to some extent, but the supply of quality retail centers, the supply part has been cut off over the last 7 years. Just because the rents don't make sense, and then apartment builders have generally always paid more for an available site. So there's been limited new construction. So I personally think that, yes, do I think we're going to lose 1 to 2% in occupancy? Probably in a severe recession. But we did extremely well during the pandemic, and I don't think we're going to get hurt as badly, frankly, as apartments, office, possibly self-storage. Industrial is unclear to me.
That's fair. Appreciate that.
I would also add, I think a lot of our tenants really adapted well in the pandemic. Think of F&B, food and beverage, restaurants doing takeout. A lot of the large retailers like Target, even the grocers figured out how to do online ordering and curbside pickup. So I think that all really speaks to our resiliency in our sector, and specifically how I think the consumers have shifted and adapted to the changing environment as well.
Looks like we have two questions, one from Paul. How many opportunities a year do you typically have available? And Paul, it would be 2 to 3. I mean, we're selective. We don't do deals to do deals. We do deals so we can make money and you can make money. We believe in fiduciary responsibility, and finding the right opportunities are important to us. Now and I'd love any feedback you all have, but what we've heard from others is they're typically looking for a total return net to them of 15. Cash is nice, but cash yield is nice, but they would prefer, something in the order of 15. I don't know, Chad, if you have any comments on that in terms of, do people prefer higher quality, lower risk, and, strong cash generation, but the total return is less? Or do they prefer a little more risk and the total return is greater?
Yeah, I mean, we've got a mixed bag in the community by all means. There's enough diversity in our group that you've got people looking for any and all of that for sure.
Okay. Lauren, there is a question here. She wants to know what states and areas in those states do you invest in?
Sure. So I think we mentioned this before, 85% of our average base rent comes from the Sunbelt markets. And so those markets tend to be the ones where we invest, and that's the Southeast, and tend to be where we have a concentration of assets because we just find there's a scalability in those markets. So in North Carolina, for instance, Charlotte and Raleigh, in Georgia, Atlanta, in Florida, we're a little spread out just because there's so many major markets in that area. But then you shift over to Texas, we're solely in Dallas and Houston. And Arizona, we are in Phoenix. Colorado, we're in Denver and Denver proper. And then California, we're typically in the LA proper area. We're a little spread out in that market down to the south, but nothing more than a 2.5 to 3 hour drive. And we're really looking for assets in any of those major MSAs.
Okay, so Brett, here's one for you. How large is your team, and do you manage the properties or use outside management companies?
Yeah, Westwood has operated very well with a head count of about 55 to 60. We do manage our properties. We're fully integrated. So we manage all of our properties. And as Mark pointed out earlier, a lot of our management offices are right there in the heart of where we have a lot of our properties concentrated. So the Phoenix office, the Dallas office, the Atlanta office, all for the properties in Arizona, Texas, and Georgia, very quick access for those employees.
Okay. Julian, what is our typical minimum investment amount?
Yeah, I think that that depends on really the deal that we're looking at, the amount of capital we're looking to raise. But I think our typical investment amount, Mark, I would say is roughly about $50,000 as a minimum. Probably depending again on the project. If it's a larger project, that can definitely scale up.
Okay. So 25 to 50 is I think would be a good range. Can you talk about a recent deal that didn't perform as well as expected, and specifically what your team did to adjust to address the particular issue? So I would say we bought a strip center and it was shadow anchored. So it's in Phoenix. Phoenix is a great market. It was called Ahwatukee. You can see it on our website at westfin.com. And when we bought it in the summer of 2019, we were buying it 65% leased at a 6.5 cap rate, right? So there's a lot of lease up potential, and that's what we saw. And we're also only paying $155 a foot, which is inexpensive for a center that was really pretty highly. It was a high quality build when it was built. And then, we hit the pandemic. So that was a problem. And we had tenants, frankly, who left. We had some restaurant tenants who left and some other tenants who left. So we were sort of in a hole on it. And Lauren and our RLD in Phoenix, regional leasing director, we're able to get it leased back up for the most part. And so now we're back up to 91%. Lauren, do you want to briefly talk about who you leased the vacant spaces to?
Yeah, sure. So about 24 months ago, I guess just right on the tail end of the pandemic, we had a vacant, since the property was owned, there was a vacant drugstore adjacent to the grocery store. And we were able to get a tenant, the name is Dogtopia, and national tenant, great credit. And so we were able to lease that space to them. In addition to that, we just did about 6 to 7 small shop leases with local, very, let's say more regional concepts. They typically had another location, and they've been performing extremely well. And so we've been really happy with the progress there.
Great. I had a couple of questions sent directly to me too. I'll throw out to you guys. The first one was, one of your slides showed that 10%-ish cash on cash was the average. Can you talk about how that generally works in a fund from year 1, year 2, year 3, year 4, year 5? What that spike or that trend tends to be on your cash on cash?
Yeah, and I want to be clear on the cash on cash, Chad, because I think that you're referring to a particular deal.
Yeah,
right.
I think that one
And
was.
that's
right.
a particular deal. So I'd say
Yep.
our average cash, again, going back to what investors are looking for, if you're doing a value add deal, and we gave you the example of the one with the Pop Shelf and the Lidl in Atlanta, great location. When you're buying something that's 74% leased, or we just talked about one that's 65% leased, obviously there's a lot of upside, but also obviously there's not going to be as much cash flow yield initially, right?
Yep.
You have to lease a space. It takes time for those tenants to get in there. And then once they're in there, then you really get some strong cash flow generation. And as importantly, you get a nice value lift. For example, the one in Phoenix that we talked about, the NOI was roughly $650,000, $700,000. And with the lease up that Lauren and her team have done, I think we're going to end up at $1 million to $1.1 million. That's a nice increase, right? We've picked up 300,000. We've driven the value from 8 million, and then you add in our capital, maybe we're at 9 million for something we think, we'll see. We're going to take it to market next year for 14 million is sort of the early thinking. So if we can make $5 million and now we're getting some pretty strong cash flow generation, I think that's interesting.
Yep.
I think Mark also, I think that 10% is that North Denver deal. And I think that plays a big part of it. So if you get really creative or a very, very good debt, then that's obviously going to help your yields.
No, I think that makes sense. Thank you. Talk about bonus depreciation. Do you do bonus depreciation on your deals? And generally, what percent of the equity multiplier is sheltered by the depreciation then?
So for bonus depreciation, I think number one, we heard from we have a dedicated senior tax manager, and what he was telling us yesterday is the bonus depreciation is going away. So in certain situations, we do use it. As far as what percentage of the equity multiple is tax sheltered, I'm not sure I can't answer. Julian, do you have an idea?
Yeah, no, I was about to say, I think this year is the last year at 100% bonus depreciation. I think, and then subsequent years after that, it's 20% drop every single year. But no, I don't have the answer off the top of my head right now. We probably have to look into exactly how much of that is going to be sheltered.
But you don't do bonus depreciation on all your assets. It's kind of situational whether you utilize it or not. Is that fair to say?
I think it's fair to say.
Okay.
And so whoever sent that question, if they can email us, and we'll talk to our tax manager and get back to them and circulate the answer to the group if you like.
Okay. That'd be great. Next one was, what are your typical loan terms? What do those look like, especially as we're heading into this economy that we're heading into?
Okay, Julian, I think that's you.
Well, one thing Westwood does every single year is, we look at our returns since inception of when we bought the properties that we currently have. We look at our levered IRRs and our NOI CAGRs. And one thing we really found surprising and not surprising, though, is when you look at all the properties we have right now, roughly 70 or so, vintage really does matter. And when we say vintage, obviously it's the year and in the cycle of the market and the environment we're in when you purchase these properties. Now, that's a little different than market timing. It's really understanding where we are currently. Chad, to your point, we're probably at a little slowdown in the economy, which is why we think it's a very prudent time to start looking to put money to work in retail properties. We think that over, look, the schedules that we've done and the returns that we showed, the CAGRs that we showed, it's very clear that you'll have double-digit returns and then some. And when you look at properties that you buy at certain vintages. So during the, right after the Great Recession, we bought a number of properties there that we just did very, very well at. Again, also it looks to where you're buying them. To Mark's point and Lauren's point of sticking with our MSAs, sticking to where we have expertise in, sticking to what Brett mentioned, where our offices are located. We have some properties that we've acquired in the past that we're looking to get out of, certain markets that we believe have a very, very anemic growth over 10 years that we just don't think it's worth being there anymore. And so those exit and focus on where we have expertise in.
And Julian, I think part of the question, if I understand, Chad, was with the current lending environment. Can you ask that again?
Yeah.
Maybe we can try and answer that a little bit better.
Yeah, just understanding kind of what you're structuring your loans as to get what kind of debt you're taking on. How does that look? I'm guessing bridge, is that variable? What understanding just.
Yeah, so we never do bridge.
Structure your deals.
We're not going to give away most of the return to the lender. So how do we structure our deals? I'll give you an example. We're looking at a deal that we like a lot right now in Raleigh, and it has a grocer, has assumable in-place debt at 3.6%. I think it's for another 8 years, et cetera. And yes, there's going to be competition on it. But with Lauren and being in Atlanta, we think that this could be a pretty good deal for us. So we are, the point on that one is, there's debt in place that we're assuming. So to us, we're basically, we're defeasing the loan risk in essence on that one. And the other thing I would say, like Julian put in place on the deal in Atlanta that we showed you, we got in essence, a 5-year loan with the right to basically prepay after 3 years. And then we have some extensions, but we size the loan to the opportunity, the expected hold, if you will. But what do we see out in the market today? It is one of very restrictive lending generally. And we expect it to stay that way through at least summer of next year. And that's being driven by some of the banks aren't getting paid off. In some cases, the Fed has raised equity requirements, et cetera. And, I think to me, it's an opportunity because if we can, get the debt right in terms of what we buy, and there's less buyers out there, I think it's interesting. Just in the same way that if you roll back to 21 and you could borrow really cheaply and people paid really low cap rates, maybe they borrowed short, et cetera. Now you have to look past that, right? You have to think, what, there should be a return to normal. And we as Westwood are willing to say, we think by next fall, there is going to be more of a return to normal on interest rates. Right now it's tough.
Yeah.
Yeah, the Atlanta deal that we did for Crowd Street, that was in that was essentially 5, and where it would be now would probably be closer to 8 or over 8, and that's the deal that we closed in August. So the environment's changed, restrictive lending, but also interest rates are going to be volatile for quite some time. So typically what we look at is core deals are going to be probably 10-year plus about 250 spread, and then it's going to go up in 100 BIP increments in terms of, all the way up to value add. Debt funds could be closer all in of 9 to 10% debt. So that's going to play a big equation, obviously. So we just have to look at creative ways to generate the returns.
Fair point. I got one more that came directly to me, and then there's a couple more in the chat now too. But I like this question that came. I think the majority of people in our community, the larger part of their portfolio is centered around multifamily. We're familiar with it. It's space that we all understand very well. And your 50 years of experience, can you talk about how grocery anchored retail stores kind of have compared against multifamily? Some maybe pros and cons that you have seen between multifamily and retail chain, just to help. We're always looking for metrics on how to measure deals and understand how to do retail. I think most of us understand the multifamily area very well and what metrics we like there. Maybe you can speak to some of the similarities and some of the differences that you've seen in your experience between the two.
Yeah, and that's probably the hardest question.
I understand. It's a
We've
very
been asked,
situational,
frankly.
personal thing, right?
Yeah, no, and by the way, Westwood used to buy apartments and found them, and it was pre my time, this is really going back to the 70s and 80s, found them fairly management intensive, et cetera. And I think my response, Chad, is, look, I think apartments are great if you catch them at the right part of the cycle. And for a pretty significant period, I think, coming out of the great financial crisis, because that basically shut off the supply of housing, or the housing stock, remember, since basically 12, 13, 14, 2012, 13, 14, it's taken a while to build up to the amount of housing we have today, which is less than the amount of housing that was being built back then, right? So I think that there's a theme there that makes sense. However, I think number one is, in a lot of the growth markets, I see a lot of building, and I mean a lot of building. And when you look at things like Green Street, which is, some of the group may know, we get their research, what they're talking about is rent decreases now on market rate apartments. And so different than workforce, et cetera, but market rate apartments, they're seeing rent decreases. And I think that just like things don't grow to the sky, you can't keep growing rents at that level, because there will be substitution on apartments, whether it's moving in with their families, moving in with friends, et cetera, moving to another community, whatever it may be. I think it seems to me it's happening. I'm not going to speak badly of apartments, because I think they're a viable asset class. I think that they're certainly you got to get your financing right. If you're financing short-term and you're buying a long-term asset, I think you could have a problem right now. Because I've seen some sponsors really put a lot of leverage on apartments. It works great when rents are going up. It works poorly when rents are going flat or down. So as far as how grocery fits into apartments, we look for, on the demo side, we're looking, many of the areas we buy in are where apartments are being built. So we get in our opinion, we get the benefit of those apartments being built without the competition, because those are shoppers for us. So as far as a precise metric, I can't give it to you at this time, but I can get back to you.
That'd be great. Yeah, we've tried to build some tools to help people analyze deals just to make a better educated decision. And we're always looking for, like, well, what's the key metric in this asset class that we maybe aren't as familiar with? So yeah, if you think of some metrics and wanted to ship them back to me, I'd love to have that and share with the group as well.
Sounds good.
Thank you for that.
Let's see. Do we have any other questions here? I think we had, how did Westwood and left field investors connect? Are you looking for new investors because previous investors aren't reinvesting? So it's a great question, Drew. We have investors who've been with us for decades, and they're in their 70s and 80s. And when you're in your 70s and 80s, you're thinking about estate planning. And I think what some of these investors are thinking about is, do I really want to put more money in something I already have done extremely well in, but doesn't offer the liquidity? And we do offer liquidity. Brett can talk about that. That is, it's in a liquid investment. So we get some of that, but we're looking for basically younger investors, because many of our investors probably average age is 70, because it was the two founders raising it. So.
Yeah, I would say that, a lot of this is about expanding the tent, right? And to the question about, are we looking for new investors because previous investors aren't reinvesting? Well, actually, our single tenant net lease fund that we did last year, over 95% of those investors were already in our fund. So there are investors reinvesting, right? So that's not the issue. I think it's, to Mark's point, it's about bringing more people in. Some investors may age out. But it's not, it's more of a a strategy of just trying to expand the footprint. And that was what we did with Crowd Street. And that's what we're looking to do in other areas.
Let's see, the last question I see from Isaac is, do you expect the higher interest rate environment to negatively impact prices when you sell? And the answer is yes. I think that if you sold if you're trying to sell in this market, and we are taking some assets out, Isaac, to market, where we're having success is small assets, $5 million, $8 million, because those are the trade buyers. We're getting pretty close to the pricing that we used to get, probably up 50 basis points. But we're doing pretty well with those. Where we're having problems is, in terms of the possibly larger deals. If a grocery anchor deal last year was 6% cap rate, today is probably 6.75. For just a sort of generic one, not generic, but just a good grocer, not a great grocer in a good market, et cetera. So. All right, Lauren, this one's for you. He wants to know, are there any newer ways to raise income? Charging for stormwater use of an on-site detention pond. That's creative. Other ways, but maybe answer a income question.
Sure. That is creative, David. But yeah, we have an ancillary income department, which their sole focus is to find alternative ways to raise income at the property, and that's through a multitude of different avenues, everything from recycle bins to throwing events at the property, in addition to several other avenues. We've recently partnered with Tesla to allow them to put their charging stations at one of our shopping centers. So we anticipate that expanding throughout the portfolio. We've also partnered with Amazon on one of our sites to do their lockers. So we are constantly looking for different avenues to raise income, but we've been extremely successful at it over the last few years, doubling our ancillary income from 2021 to 2022.
For a total amount of?
Approximately $1.1 million is what I saw earlier today.
Across the portfolio, right?
That's correct.
Yep.
That's correct.
Yep.
That's great. Any other questions? We've been firing them at you. It looks like it's slowing down a little bit. We're about up to our hour, but any other questions real quick before we're finished up? Really appreciate the time with you guys today and your patience with the questions and everything like that. I think that's fantastic.
Great questions, by the way. So
good. Yeah, we got a laser focused group here, I tell you. Oh, here we go. How confident are you in the
Cash on cash, 10%?
I'm very confident on the cash on that particular deal because we have basically longer term leases. We have the debt in place. Now that cash on cash is through the whole period of 5 years. So we have, the debt in place through September of 25. We have obviously the refi at that point, but since the first 3 years are pretty much set, the last 2 years are, we use a forward curve on the interest rate to look at that. But I'd say
at the very most, it'll be a little over 4% because we can take it down unencumbered.
Yeah. So eight. And Julie, when you say 4%, you're talking about the interest rate, right?
Yeah, because yes, we have locked in interest rate on our overall facility at a little over 4%. So it'll just go from high 3s to low 4s.
Yeah.
It won't
I think what we see, there's a basic bifurcation. You can have a total return that's in the 10 to 11 to 12 range and have a higher cash return because you're buying something that's basically leased, you're putting good debt on place. And that was what I was talking about in Raleigh. Or you can do something like we did in Atlanta, where you got some lease up to do, you're taking a lower cash return in the beginning, and then you have to wait for a year, 2, 3 to get a higher cash return because you have to do the lease up. But we have a great leasing platform. I mean, Lauren ran the Southeast for a major REIT on the leasing side. She knows everyone. So we do extremely well on the leasing side, which is why we like both deals actually, or both types of deals, but I just wanted to mention that.
Great. Well, hey, I'll cut it off there so we don't take up or overlap on too much time. But thank you very much for your time today and answer the questions and the material. I think this was great. Again, to the community, anybody listening or that happens to listen to the podcast, if you're interested, please reach out to the group. They can find you at Westwood Financial, and feel free to reach out and get in touch with them, do your vetting, and see if it's somebody you want to follow up with. But thank you guys and gals very much for coming on board, and hope you have a good weekend.
Thanks. And Chad, if anyone wants it, once again, if anyone wants the deck, email us and we'll get the deck to you.
Sounds good.
It'll be on the, you're sending the video around, right?
Yep. So we'll put
Okay.
contact info in there.
All right.
That'll
Sounds
work.
good. Thank you.
Thank you.
Yeah.
Thanks, everybody.
Thank you,
Have a good
guys.
day. Take care.
Bye-bye.
Everyone.